Hello everyone, this is Victor here. Welcome back to the Intelligent Investor channel. In today's video, I'm going to analyze Disney stock. I'm going to explain why I think Disney stock will likely turn around more going forward. Before I start, I'd like to give you some context first. Disney stock has not done very well over the past 5 years compared to the S&P 500. Disney overspent on content and mismanaged its businesses, especially its direct-to-consumer Disney Plus business. This is why you can see that Disney stock has dropped a lot since the peak in 2021. In comparison, the S&P 500 has already recovered a lot. If you look at the past 10 years performance, you can see that Disney stock also underperformed the S&P 500 substantially. This is mainly because of the large drop since 2021. Without this large drop, Disney should perform similar to the S&P 500. Disney's most important and most profitable business, its theme parks and resorts business, was greatly impacted during the pandemic. Now Disney's theme parks business has recovered a lot, but the stock is still down a lot, near a 5-year low. So in this video, I'm going to explain why I think Disney stock will recover more going forward. I will talk about Disney's growth strategies going forward. In this video, you will learn about Disney's biggest risk, why I think Disney stock will likely turn around going forward, Disney's stock valuation, and will I buy Disney stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock reviews and investing videos every week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members grow their stock portfolios to over 7 figures over time. Once you become a Patreon member, you can follow all the stocks I'm investing for the long term and download the latest intrinsic value calculators for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Full disclosure, at the time of making this video, I don't have Disney stock in this portfolio. I also have other stock portfolios with almost the same stocks as this portfolio. I don't have Disney stock in other portfolios. 2 years ago, I made this Disney stock analysis video. I said that I would not buy Disney stock because there are many companies such as Google and Microsoft that are much better managed and have much higher growth rates than Disney. Back then, I didn't buy Disney stock because I didn't like Disney's content strategy. Disney was essentially overspending on content in order to grow Disney Plus subscriber base. Building Disney Plus is very capital intensive. Similar to Netflix, Disney has to spend billions on content every year in order to build out Disney's subscriber base. This means Disney Plus will continue to lose a lot of money for many quarters before it can become profitable. Back then, Disney's theme parks business was greatly impacted by the pandemic, so I didn't buy Disney stock. Fast forward to today, you can see that Disney stock did drop a lot over the past 2 years. Looking at this in hindsight, I was very lucky not to buy Disney stock. I dodged a bullet here. In my opinion, I think Disney was a value trap even though Disney stock appeared to be undervalued. The important question is this, will Disney's business recover going forward? As long as Disney's business is recovering, the stock will eventually follow and recover. Also, I think it's very important to understand Disney's biggest risk and headwinds going forward. If you look at Disney's most recent financials here, you will notice that Disney recently reorganized its businesses into these 3 business segments. Entertainment segment, which includes Disney Plus, traditional TV networks such as ABC, Disney Channel, FX, National Geographic, and other TV assets. Sports segment, which includes ESPN and ESPN Plus. And experiences segment, which includes Disney theme parks, cruises, and resorts. I will go over these 3 business segments here so you will know biggest risk and headwinds going forward. Here is the biggest headwind that is affecting Disney right now. More people will continue to cut their cable and TV subscriptions and switch to online streaming services such as Netflix, Disney Plus, Hulu, Amazon Prime Video, and HBO Max. Here you can see that Disney's linear networks revenue decreased slightly year over year and its operating income stayed flat year over year. Just to compare, Disney's direct-to-consumer revenue, which includes Disney Plus, increased a lot more year over year, and its operating loss is much less compared to last year. This trend will continue as more consumers cut their cables and switch to online streaming services. Disney's linear networks, or its traditional TV networks business, will continue to have lower revenues and lower operating income over time. Here's the important part you should know. Going forward, Disney's most important strategy is to grow its direct-to-consumer streaming business and make it as profitable as Netflix. The biggest issue is that it is very expensive and capital intensive to build a very successful direct-to-consumer streaming business like Netflix. For example, if you look at this here, you can see that it took Netflix many years to become profitable. As of now, Netflix is expected to have around 247 million paid members by year end. Its operating margin is expected to be around 20% by the end of 2023. Just to compare, Disney Plus has around 112 million core subscribers. If we combine Disney Plus core subscribers with Hulu subscribers and Hotstar subscribers, Disney has nearly 200 million paid subscribers in total. But Disney's online streaming business is still not as profitable as Netflix. For example, when Netflix had around 200 million paid members back in 2020, Netflix was already profitable. Netflix already had a consistent operating margin and started generating positive free cash flows. In comparison, you can see that this is DTC, direct-to-consumer streaming business, is still losing a lot of money, even though Disney has nearly 200 million paid subscribers in total, if we combine all of Disney's streaming services. This shows that Disney is not managing its streaming business well enough, especially content spending and marketing. Disney expects that its streaming business will become profitable by Q4 of fiscal 2024, but of course, Disney's streaming business operating margin will be very low at first. In terms of competition, Disney Plus and its Hulu streaming service have a lot of competition. To stay competitive, Disney will need to invest billions in content every year, similar to Netflix. So I don't expect Disney's streaming business will be as profitable as Netflix anytime soon. It took Netflix many years to become profitable and have a 20% operating margin. Even if Disney's streaming business becomes profitable by Q4 of fiscal 2024, its operating profit will be very small and it will have no impact on Disney's overall profit. Over the next several years, I believe most of Disney's operating income and free cash flows will still be from Disney's theme parks business, ESPN, and its traditional TV networks business. I think it will take Disney's streaming business many years to become profitable like Netflix. Here is another headwind we should consider. Disney bought out 21st Century Fox for $71 billion back in March 2019. In my opinion, I believe Disney overpaid to buy out 21st Century Fox. According to the Wall Street Journal here, the deal was initially $52 billion, but Disney had to compete with Comcast to buy out most of 21st Century's assets. Disney eventually had to pay a huge premium and bought 21st Century Fox for $71 billion, almost $20 billion more than the original price. Here is the problem. Disney had to issue a lot of shares to buy out 21st Century Fox assets, which in my opinion destroyed shareholder values. Also, you can see that Disney's free cash flow dropped substantially after Disney buying out 21st Century Fox. Of course, the pandemic in 2020 and 2021 affected Disney's free cash flow the most. Now, Disney's free cash flow is recovering. Based on my understanding, Disney's financials would be much better if Disney did not overpay to buy 21st Century Fox for $71 billion. Here is another issue we should consider. If you look at these financials here, you can see that Disney has to add back around $2 billion of non-cash amortization of 21st Century Fox and Hulu intangible assets to its pre-tax income every year. This shows that Disney overpaid for 21st Century Fox assets, and this will continue to affect Disney's operating margin going forward for at least the next several years. Personally, I don't like it when management adds back these non-cash items to make the company's earnings look better. I think this is a bit misleading for investors. Here is another headwind. At the time of making this video, Disney has around $14 billion of cash. In comparison, Disney has around 4 times more debts compared to cash. Disney has around $46 billion in total debt. Most of it is long-term debt. Ideally, I like companies that have much less debt. Disney is planning to buy the remaining 33% stake in Hulu from Comcast. This will cost Disney at least $8.61 billion. This will allow Disney to have full control of Hulu going forward. Also, Disney is planning to start paying dividends again by year end, but the dividends will be very small at first. This means Disney may need to issue more debt in order to buy out the remaining 33% stake in Hulu from Comcast, while still paying small dividends to shareholders going forward. Personally, I don't think Disney should pay dividends. I think Disney should keep more cash and wait until its streaming business becomes more profitable first before paying dividends to shareholders again. So why do I think Disney will likely turn around and recover more going forward? I think we have to look at Disney's growth strategy and Disney's free cash flow growth going forward. I think there are several things that indicate that Disney is likely turning around going forward. First, if you look at these financials here, you can see that Disney's free cash flow has improved a lot year over year from 2022 to 2023. Disney's revenues and segment operating income did grow year over year, but the growth rates were very low. Disney's businesses are very mature. This suggests that Disney's revenue growth rates should be in the single digits going forward, not double-digit revenue growth rates. Here, you can see that Disney's operating income and free cash flow are starting to recover. For example, Disney's free cash flow was around $1 billion in fiscal 2022. Now its free cash flow is around $4.9 billion in fiscal 2023. According to the latest earnings call, Disney expects that its free cash flow will grow to around $8 billion in fiscal 2024. This is getting to the free cash flow level right before the pandemic. Disney CEO Bob Iger said this in the most recent earnings release. He explained that there are 4 key growth strategies for Disney going forward. As we look forward, there are 4 key building opportunities that will be central to our success. Achieving significant and sustained profitability in our streaming business, building ESPN into the preeminent digital sports platform, improving the output and economics of our film studios, and turbocharging growth in our parks and experiences business. Disney's management said this in the recent earnings call. Our expense base in fiscal 2024 is expected to only increase slightly versus the prior year, as these efficiencies and strike savings will mostly offset the year's planned volume-related growth and inflation. Adding the new $4.5 billion cash content spend reduction target to the $3 billion expense target brings our total annualized target to $7.5 billion, as Bob announced earlier. All of these factors, in addition to continued growth and improvement across our underlying businesses, are expected to come together over the coming fiscal year to result in free cash flow generation of roughly $8 billion. A significant year-over-year increase and approaching levels we last achieved pre-pandemic. I think Bob Iger is mostly right about Disney's growth strategies here. The only thing we should keep in mind is that Disney's businesses are very mature, so we should not expect Disney to have high growth rates going forward. Realistically, Disney's turnaround should be very slow, and it will probably take Disney at least several years to turn around. So here's Disney's turnaround strategy. First, Disney will reduce content spending and focus much more on profits going forward. Instead of releasing too many movies and shows like before, Disney will focus on fewer high-quality content that can become larger franchises going forward. In the past several years, Disney was much more focused on growing Disney Plus subscriber base at the expense of profit. This is why Disney overspent on content and marketing between 2020 and 2022. Now, Disney is much more focused on driving profits for its streaming business. Disney still expects that its streaming business will become profitable by the end of fiscal 2024. I said this earlier, realistically, even if Disney's streaming business becomes profitable by the end of fiscal 2024, the operating margin will be very small. It will not have a huge impact on Disney's overall profit. I think it will take Disney's streaming business many years to become more profitable like Netflix. The current ESPN business is still very profitable for Disney, but its growth has slowed down a lot in recent years. Going forward, Disney is planning to transition most of ESPN into a direct-to-consumer streaming business. Disney believes that the direct-to-consumer streaming business model is the future of Disney. This is because streaming services are growing much faster than traditional TV networks. Consumers will continue to cut their cables and switch to more streaming services like Netflix and Disney+. Of course, this trend will continue to impact Disney's traditional TV networks going forward. This is why Disney's most important strategy is to switch more businesses, such as ESPN, to streaming services. Realistically, I think it is very hard to know whether ESPN will grow again and become more profitable once it switches to a more direct-to-consumer business model. Disney's most important and most profitable business is its theme parks business. It's almost impossible for competitors to copy Disney's theme parks and resorts. Disney has the most valuable IPs in the world, such as Marvel, Star Wars, Pixar, and of course Disney characters. So Disney will continue to leverage its IPs and invest a lot more in its theme parks business going forward. Disney is planning to become much more cost efficient going forward. For example, Disney is planning to cut operating costs by as much as $7.5 billion by the end of fiscal 2024. The biggest portion of this cost savings is reducing content spending. This is why Disney expects that its free cash flow will reach around $8 billion in fiscal 2024. This is almost as high as its free cash flow back in 2016 and 2017. I think this shows that Disney will become more cost efficient going forward instead of overspending on content, marketing, and other expenses. Overall, if we consider Disney's growth strategies and the cost saving strategy, I think Disney will become more cost efficient, have higher free cash flows again, and eventually turn around going forward. Of course, we have to be realistic. I believe it will take Disney many years to recover because Disney's business is very mature. Disney's revenue growth rate is usually in the single digits. Even if Disney is transitioning more businesses to streaming services such as Disney Plus, Hulu, Hotstar, and ESPN Plus, it will take Disney's streaming business many years to become as profitable as Netflix. And if you compare Netflix operating margin to Disney's direct-to-consumer streaming business operating margin, you will notice that Netflix is much better managed than Disney's streaming business, especially in content spending and marketing. So going forward, I think Disney has the right strategies, but it should take the company many years to recover. I want to show you the consensus forecast for Disney here. According to Seeking Alpha, Disney's revenue is expected to have mid to high single-digit growth rates over the next 3 years. But if you look at Disney's EPS estimates, you can see that Disney's earnings per share is expected to grow much higher than its revenue growth over the next 3 years. I think this is because Disney is expected to reduce its content spending more, sell TV networks and assets that are not performing, reduce operating costs, and perhaps buy back shares once Disney's free cash flow returns to the pre-pandemic level. I want to show you how to calculate Disney stock's intrinsic value here, so you will know when Disney stock becomes undervalued, fairly valued, or overvalued. If you want this calculator, you can download it from my Patreon blog. The link is in the video description. First, I'm not using a DCF model to estimate Disney's intrinsic value because Disney's free cash flow is not stable and not consistent enough yet. I'm using a simplified sum of the parts valuation model here, since Disney has these 3 business segments: entertainment, sports, and experiences. Let's go over these 3 business segments here. For Disney's entertainment business, I'm using these companies as comparable businesses. They are Disney's closest competitors in the online streaming business and traditional TV networks. Based on an average price to sales of 3.23, I believe this business intrinsic value should be around 131 billion. For Disney's sports business, I'm using these companies as comparable businesses. These companies are the closest competitors I can find. Based on an average price to sales of 1.35, I believe this business intrinsic value should be around 23 billion. For Disney's experiences business, I'm using these companies as comparable businesses. They are Disney's closest competitors in the theme parks business. Based on an average price to sales of 2.47, I believe this business intrinsic value should be around 80 billion. Once we add all these businesses together, I believe Disney's intrinsic value should be around 203 billion for the entire company, or around $110 per share. I also used the forward price to sales valuation model here to estimate Disney's intrinsic value, which should be around 277 billion for the entire company, or around $151 per share. If we take the average of both valuation models here, I believe Disney's intrinsic value should be around $131 per share. Just to compare, Morningstar gave Disney a much higher fair value of $145 per share. This means I believe Disney is likely undervalued at the time of making this video. So will I buy Disney stock? Personally, I'm not planning to buy Disney stock, even though I think Disney's business will eventually turn around because of the growth and cost saving strategies I talked about earlier. There are several reasons I'm not planning to buy Disney stock. I don't think Disney can outperform the S&P 500 over the next 10 years. There are many companies that are much better managed, have high growth rates, and are much more profitable than Disney. I believe it will take Disney's direct-to-consumer streaming business much longer to become as profitable as Netflix. Disney's free cash flow margin, return on equity, return on invested capital, and return on assets tend to be very low. For example, if you look at these financials here, you can see that Disney's free cash flow margin, return on equity, return on invested capital, and return on assets are very low, well below 10%. Ideally, I like businesses that have most of these financials above 10%. Here's another reason I'm not planning to buy Disney, even though I think it will eventually turn around. I'm mainly a growth investor. I prefer companies such as Apple, Google, Microsoft, Nvidia, Tesla, Visa, and MasterCard. I'll give you an example here. This is one of my stock portfolios. This portfolio has done very well because I have invested in some of the best businesses that have large economic moats, great management, great products and services. increasing earnings and increasing free cash flows over time. I always like to invest in the best businesses that are undervalued. Then I like to hold them for the long term and let their intrinsic business values grow substantially over time. This long-term strategy has worked very well for me for many years. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.